All right, well, thank you very much to the organizers for including our paper on the program. This is joint work with Stefano, Giglio, and our paper is on this idea that no news is news, and we test whether markets underreact to nothing. So our research is motivated by this idea that no news and the passage of time often contains important information. So you can think about this in general context. So suppose you're a voter and you see a sustained period of time without terrorist attacks. You might be justified in updating positively on the government's ability to prevent terrorist attacks. Or alternatively, suppose you're a manager and you see that your employee executes a task without screwing up. You could then update positively on this employee's underlying quality. More generally, you can think about situations that fit this idea of the famous Sherlock Holmes story of the dog that didn't bark. So Sherlock Holmes is able to say who committed the crime in the middle of the night using the fact that the dog did not bark. So therefore, the crime had to have been committed by someone familiar to the dog. No news is also news in many financial contexts. So suppose you're an investor and you see that a firm gets a negative shock. After the shock, you see that the firm does not default, does not declare bankruptcy or lay off workers. In that situation, you might want to update positively on the underlying fundamental strength of the firm. Another situation is, suppose you're an investor and you see that the firm continuously does not announce new investment projects. In that situation, you might want to update negatively on the firm's investment opportunity set. So in this paper, what we do is we test how people react to no news. And broadly, we can separate the reactions into two categories. So the first would be a rational response. This would be Bayesian updating on no news events. So this has the important implication that in rational markets, prices can drift along a path of no news. Because if you're expecting something bad to happen and it doesn't, the prices should drift up and vice versa. So there is some research showing that, at least in the context of insider trading, market participants seem to kind of get it. Alternatively, there could be a behavioral response, and this is imperfect updating on no news events. So this relates to the broader literature on limited attention, including work by our discussant Shane. So this is the idea that attention tends to be directed at more salient or vivid signals. Now, you might think that no news and the passage of time would tend to be less salient and less vivid because by definition they weren't worthy of explicit news coverage. So underreaction to no news can be very important because it can cause persistent misallocation of resources, because no news itself tends to move very slowly. And in addition, it's rather pervasive because the passage of time is literally occurring all the time. All right, so the empirical context that we're going to use to test this is that of mergers. This is a convenient setting to test for reactions to no news because, first of all, there's a clear starting point, which is the announcement of the intention to merge. After the announcement, the target price of the merger is going to depend heavily on a clearly defined and risky endpoint. So that could either be completion, and if the merger completes, that usually occurs about 4 to 5 months after merger announcement, or there could be a merger withdrawal. For example, if the SEC or Department of Justice blocks it, or if shareholder approval falls through, or acquire financing falls through. So before I get to the empirical methods, let me clearly distinguish between what we mean by no news and the passage of time versus explicit news. So explicit news, including news stories or rumors about whether this merger is going to complete, can definitely be released after merger announcement. And I'm just going to try to explain why this is not a problem for our methodology. So what we do is we define the no news component of each day as the passage of time. So no news is what we as market participants should learn about the merger completion probability, even if we are unable to observe any explicit news. And we're going to measure the information content of the passage of time by estimating event time variation in these empirical hazard rates of merger completion. So what's important is that explicit news and the passage of time may contain sometimes the same information. So what we're going to argue is that it's possible that the market underreacts to both explicit news and the passage of time. However, at a minimum, we can show that the market is going to be underreacting to the passage of time. So let me give you an example of this happening. So in this simple example, suppose that historically we know that after month 6, the hazard rate of merger completion just falls to 0. Okay? This means that even if we are unable to observe any explicit news, once we reach month 6, the price of the target should drop. This is the information content of the passage of time. Now suppose at month 6, we also receive a news report telling us this merger is dead. Okay? If in this case we still see that the price doesn't drop, then agents must be underreacting to both signals, both of which tell you the same information. Now, we can never hope to observe all the possible insider rumors that are going around about merger completion. But we are going to show you that as hazard rates go up and down, returns are predictable. So that means at a minimum, agents are underreacting to the information content tied to the passage of time. All right. Let me now return to our empirical methodology. We're going to focus on 2 types of mergers. The first is cash finance mergers, in which target shareholders obtain a fixed dollar per share. Our second type of merger is equity finance mergers. So here the target receives delta shares of the acquirer per share of the target. We're going to exclude more complicated mergers and also tender offers which have known expiration dates. So these tender offers tend to occur very quickly, and because they have expiration dates, the information content tied to the passage of time tends to be much more obvious. All right, so here's an outline for the rest of the talk. First, I'm going to show you that hazard rates are indeed non-constant, and that these hazard rates do predict returns. Then we'll argue that this is explained by a simple behavioral underreaction model. And finally, we'll go into alternative rational explanations, such as event time variation in risk. So are merger hazard rates non-constant? No news is news if the underlying hazard rate of merger completion is non-constant. So we're going to measure empirical hazard rates of both completion and withdrawal. Here, H of t is a probability of merger completion during period t, conditional on no completion or merger withdrawal prior to period t. Similarly, W of t is the probability of withdrawal during period t, conditional on no completion or withdrawal prior to period t. So here's what we estimate separately for cash mergers on the left and equity finance mergers on the right. So here we have event time on the x-axis and hazard rates on the y-axis. The blue curve that's very hump-shaped is the hazard rate of merger completion. You can see that's very non-constant in time. So for example, for cash mergers, merger completion is very unlikely right after announcement and about a year after announcement, and it peaks around event week 25. Similarly for equity finance mergers. In contrast, if you look at hazard rates of merger withdrawal, that's this pink line here, those tend to be very low and flat throughout event time. Okay, this means that in the future slides I'm going to show you, we're going to focus on this hazard rate of merger completion just to simplify the presentation here. Okay, so this is the aggregate estimate using our full sample from 1970 to today. If we break this down across calendar time, it's extremely stable. So this shape of the hazard curve has not really changed over time. All right. What I've shown you so far is a very rough approximation of merger hazard rates. There could be a lot of individual heterogeneities. For example, mergers in regulated industries tend to take longer. Other merger hazard rates, they have the same shape, but they're kind of shifted up or down depending on whether it's more or less likely to happen. The bottom line, though, is this is going to be a bias against us. We may be estimating these hazard rates with error. However, we're going to show you that even these possibly poorly estimated hazard rates are going to really strongly predict returns. All right, so let me now move to returns. Rational markets should incorporate all available information. That means that if from past experience we know that the merger is likely to complete tomorrow, the target share price should be high today, such that the expected return between today and tomorrow only compensates me for risk. Therefore, if risk is constant in event time, we would also expect returns to be constant in event time. The puzzle I'm going to show you is that returns are actually very predictable in event time, and further that they align very well with hazard rates in event time. So here's what we actually find for returns. The standard error bars seem to have gone missing, but let's just look at the curves for now. So on the top panel are the hazard rates that I showed you before. On the bottom panel are the returns curves. So what you see is that returns are also very non-constant in event time. And the difference between the minimum and maximum weekly returns, which is what we're plotting here, is 30 to 35 basis points per week. So there's a lot of event time variation in returns for both cash and equity finance mergers. You also note that both for equity and cash mergers, there's a slight blip in the returns toward the end of event life. I'm going to return to this point later. This is consistent with markets kind of catching up with this idea that mergers are unlikely to complete by the end of event life. All right. So why would hazard rates predict returns? We usually don't expect returns to vary predictably over time unless one of these two things is going on. So first, there could be behavioral biases, and then limits to arbitrage preventing more sophisticated arbitrageurs from arbitraging this away. Alternatively, there could be changes in risk or risk frictions. So let me first explore the behavioral biases story. So here's a simple behavioral model of underreaction that can explain this returns pattern. Suppose at time t equals 0, the merger is announced, and the acquirer offers price PC for the target. Let p hat of t be the price of the target conditional on no completion or withdrawal up to time t. Then we say that if the merger completes, the price is going to jump from whatever it is up to PC, and if the acquirer withdraws, the price is going to revert to some p naught, which follows this underlying process. Okay? We can then solve for p hat, that's the price of the target conditional on no completion or withdrawal yet, and that's going to depend on the market's beliefs about completion probabilities. We'll call those beliefs h hat. However, realized returns are going to depend both on the market's beliefs about completion probabilities as well as the true hazard rates h of t. And this is because every period I might have some beliefs about completion, but when the completion actually happens, the price is going to go up to PC, and if there's a withdrawal, the price is going to go down to P0. So the realized returns depend on both beliefs about hazard rates and true hazard rates. All right, so here are the model predictions about returns. For now, suppose unrealistically that all risk is idiosyncratic, because I just want to show you that a behavioral model can explain these return patterns. So if beliefs are correct, the model implies that mean excess returns should always be 0. However, if the market underestimates the true hazard rate of merger completion, then mean excess returns will be greater than 0 because the market gets positive surprises from completion. So for example, I expect the merger will complete tomorrow with probability 50. I price the target accordingly today. However, the merger actually completes tomorrow with probability 75. Then I'm going to get a positive surprise, so returns are going to be positive. And vice versa. So if I overestimate the hazard rate of completion, I'm going to get negative surprises on average, so the return will be negative. Now let's connect this back to underreaction. So if agents underreact to no news, they're not going to recognize all the time variation in this hump-shaped hazard rate. So the beliefs about hazard rates are going to be flatter than the true hazard rates. This means that agents will tend to underestimate H when H is high and overestimate H when H is low. This generates positive correlation between hazard rates and returns. Now note these predictions are still going to hold if there is constant systematic risk over event time. We're going to talk about what happens when risk is changed in event time later. All right. So what we can do now is use the model to back out the set of beliefs about hazard rates that would be required to generate the returns pattern that we saw. Okay, so in the black line shows the estimated true hazard rate for cash and finance mergers, cash and equity finance mergers. The dotted blue line are the set of beliefs that the market would have to hold to generate this returns pattern. What we show is that these beliefs are flatter than the true hazard rates. So they're not completely flat. The market is not completely stupid, but they don't capture the full event time variation. The other thing that you'll see is that the dotted blue line and the black line tends to converge toward the end of event life. This is not something we impose, it's just something we find with the data, and this is consistent with the idea that as 1 year passes after merger announcement, the market correctly realizes that these hazard rates of merger completion are now pretty low. The merger is now very unlikely to complete. All right. Let me go into one additional nuance about our focus on hazard rates. So we focus on the hazard rate because it's one very important reason why the passage of time contains information, but it need not be the only reason. So the passage of time could contain other information. For example, the value of the target in the absence of a merger, or the probability of receiving a nice competing bid from another acquirer. Those might vary in event time with hazard rates as well. We check this empirically. It seems to not be a very strong phenomenon. We want to allow for this to be happening. So if this stuff is happening in the background, that means we can't distinguish between two things. First, the market underreacts to changes in the hazard rate, Or the second case, markets know all about hazard rates, they have correct beliefs about the hazard rate, but they fail to update on other changes to real cash flows of merger value that move in with hazard rates in event time. Even though we can't separate these two stories, they're going to be fine for our theory because both represent underreaction to the passage of time. All right, let me now turn to risk as an alternative explanation. So first, let's note that the results cannot be driven by calendar time variation in risk because this is a phenomenon measured in event time. What we have is over 5,000 mergers staggered across calendar time. Now you might think, what about merger waves? Well, merger waves occur in the wrong time horizon. Merger waves last several years. We're talking about a phenomenon in event months. Further, the positive correlation between returns and hazard rates remains very strong if we introduce calendar year by month fixed effects in all the regressions. What's more concerning is what if risk covaries with hazard rates in event time? So as returns go like this, maybe in event time risk is very high during this intermediate period in event time. So we're going to explore this using a time series portfolio of returns to explore event time variation in systematic risk, downside risk, so that's the probability that you lose a lot when the market during extreme market downturns. And finally, we might be concerned about idiosyncratic risk, which might be priced in this context because merger arbitrageurs are constrained to hold portfolios only consisting of mergers. All right, so here's how we explore risk. We're going to develop trading strategies in calendar time. So for a cash merger, we just buy one share of the target. For an equity finance merger, we buy the target and then we short delta shares of the acquirer. Each month, we invest equally in all deals that are active within certain event windows, which I'll describe in the next slide. This is a modification of the standard traditional merger arbitrage strategy described in Mitchell and Polvino. So the traditional merger arbitrage strategy is to enter after announcement and then you just buy and hold until something happens, until completion or withdrawal. We're just going to modify that slightly. So to modify it, first we start with only information about hazard rates measured using a previous historical sample. We take the mean of that hazard rate and then divide event time into 3 regions in which the hazard rates are below the mean or above the mean. So we have a low hazard 1 and a low hazard 2 region, and then a high hazard region in the middle. Then we have 3 strategies that only invest in deals active within their own relevant event windows. So for example, our high hazard strategy, in each calendar month, we look around and we look for all deals that are active between event weeks 12 and 36, and if they're there, we invest in those deals. What the rational theory would suggest is that after controlling for risk, the alphas of all these strategies are going to be equal to one another, even if the high hazard strategy has higher average returns overall. Here's what we actually find. These are the strategy Fama French alphas. So for example, for our cash strategy, for a high hazard, we get a monthly alpha of 64 basis points compared to the 2 low hazard strategies that actually have slightly negative alphas of -5 and -7 basis points per month. You can also compare that to the buy and hold alpha. It's not surprising the buy and hold alpha is somewhere between the high and low hazard alphas because the buy and hold strategy invests in deals throughout their event life. All right, you can also look at equity finance mergers. Again, the alpha of the high hazard strategy is significantly larger than the alphas of the 2 low hazard strategies. And here the difference is even larger. And we can test whether these differences are significant in this column. So these are the results for the full sample. We can also split it so that there's no look-ahead bias, so that we can compute hazard rates in an earlier period from 1970 to 1990, and then trade using those hazard rate event windows in a later period from 1991 to 2010. We get very similar results. All right. We can also look directly at whether risk itself is changing in event time. So all of our Fama French betas are pretty small, as is consistent with the findings in the merger arbitrage literature, of less than 0.3. More importantly, for our theory, these Fama French betas do not vary in event time. So the betas in this high hazard period is not larger than the betas in the 2 low hazard periods. Also, the following other risk factors do not vary significantly in event time. So the momentum beta is not hump-shaped. It is pretty flat. Downside risk is not varying in event time. idiosyncratic risk is also not varying in event time. And the reason idiosyncratic risk isn't varying in event time is because usually our strategy is already diversified across at least 20 active mergers. So all of this jump risk from merger completion is quickly diversified away. Finally, we test whether exposure to Agarwal and Nike option factors vary in event time. Again, they don't. So all this is to show that it's not the case that risk is zero. All of this risk is there and is contributing to the alpha of the buy and hold strategy, but these risks are not varying in event time, and they can explain this hump shape in returns over event life that we observe. Now let me turn to some other rational explanations. So from talking to people working in merger arbitrage, they suggest that a big part of their returns comes from capturing the buying and selling pressures from liquidity traders. So this is definitely an important phenomenon. What happens is right after merger announcement, a lot of mutual funds sell the target to lock in the gains directly from merger announcement. And also they don't want to hold onto these targets anymore because M&A strategy doesn't really fit their investment focus. Now suppose that arbitrageurs are not able to move fast enough to relieve the selling pressure. This would make the price very low and it would kind of go up. This suggests that market liquidity measures such as volume or turnover should move negatively with returns in event time. Another explanation that's rational might be information asymmetry may be varying in event time. And again, this is compensated for in terms of returns. So this would suggest that the bid-ask spread should move again with returns in event time. What we actually find is that volume, turnover, bid-ask spread, they're not constant event time, but their major movement centers right around announcement, and in the relevant window where we have our variation in returns, they're not moving and they're constant. So for example, this is what's happening with volume. On the top, we plot our returns pattern, and on the bottom, we plot what's happening in terms of volume for the target. So you see volume is definitely not constant, it spikes up. But in this relevant period about 1 month, or sorry, 1 year after merger announcement, during that period, volume is extremely flat. Same for turnover and bid-ask spread. So let me now turn to limits to arbitrage. So we've shown that a behavioral underreaction model can explain these returns patterns. However, we know that sophisticated merger arbitrageurs are likely to exist. So why do they allow these returns patterns to persist? We find that this is probably due to a lack of liquidity, transaction costs, and price impact, particularly because targets tend to be fairly small. What we can do to explore trading frictions is we split our sample in half in terms of measures of liquidity. So we can split it in half in terms of the size of the target, volume, bid-ask spread, and we can also split it in terms of an early period or a late period. And what we always find is that the alphas for the smaller and less liquid half of the sample are much, much larger than the alphas for the more liquid halves of the sample. The alphas are usually more than 2 times larger, and the differences are highly significant. The only split where we don't find a major difference is when we split by time period. So it's true that the alphas for the earlier time period are a bit larger than those in the later time period, but here the difference is not as dramatic. We can also look directly at trading costs if we were to simulate a more realistic trading strategy. So here we simulate trading strategies following the RAIN portfolio in Mitchell and Polvino's work, which built on earlier work by Breen et al. So what we do is we start a portfolio with $1 million in 1970, and then we impose these constraints. So the maximum portfolio weight on any deal is 10%, and then we include conservative estimates of indirect and direct transaction costs. So indirect transaction costs are those that you would suffer because of price impact or illiquidity, and then direct transaction costs are things like brokerage commissions. So here we have the alphas from our no trading costs strategy. We see very high alphas for our high hazard strategy and the large event time differences. If we focus on the trading cost alpha, it goes down dramatically. So a lot of this is cut down once we account for trading costs. That said, the alphas of our high hazard strategy are still higher than the alphas of our 2 low hazard strategies. This is itself not surprising because even though transaction costs are likely to be a factor, they're not that much higher if you focus on the high hazard window rather than other event windows. All right, let me now turn to one bit of robustness before I conclude. What I've shown you is that the alphas for our high hazard event window is larger than the alphas for our two low hazard event windows. What I want to show you now is that the exact cutoffs for these event windows, it doesn't really matter. We can move those cutoffs around a lot and still get similar results. So each of these squares is the alpha from a different investment strategy that focuses on different event windows. So for example, if you look at this dot here, that's the alpha from an investment strategy that only invests in deals that are active between event weeks 12 and 36. Okay? These black circles are the alphas of our two low hazard strategies, and this white circle is the alpha of our high hazard strategy. What you can see is that the alpha of our high hazard strategy is kind of located in a large zone of high alphas. Meanwhile, the alphas of our two low hazard strategies is located in a zone of rather cool colored alphas. So if we were to shift those event windows a little bit, it wouldn't really change our results. Similarly for equity finance mergers, so here the differences are even a bit more dramatic. Our high hazard alpha is located in a hot zone. So if you were to move that, perturb that a little bit, it really wouldn't matter. Again, our two low hazard strategies are located in cool zones. If we change those event windows a little bit, it also wouldn't matter. So this goes to show you that if you were investing in these mergers to make more money, all you would have to do, you wouldn't have to get your hazard rates exactly right. As long as you start investing in mergers maybe a month or two after the announcement, and then you pull out maybe 7 or 8 months after announcement, you would make more money than the buy and hold strategy, and also more than if you invested in these two low hazard windows. All right. So let me now conclude. In this paper, we test whether markets underreact to no news using the empirical context of mergers. We find that merger returns track hazard rates of completion in event time, so both are very hump-shaped in event time. These patterns are explained by a model of flat beliefs about the hazard rates, in which the market fails to appreciate that hazard rates are very time varying. And it's not explained by event time variation in risks or risk frictions, which definitely exist in this context, but they don't change in event time. So this is overall consistent with a behavioral underreaction model and to the presence of limits to arbitrage, which prevent more sophisticated investors from arbitraging all of this away. So let me end with this idea that we focused on mergers because it's a really convenient context to test for underreaction to no news. However, underreaction to no news may itself be a much more general phenomenon that may cause persistent misallocation of resources in many other contexts in which arbitrage may be even more difficult. So you can think back to investors and firms trying to figure out what the firm is doing with its investment opportunity set. You can think about voters and politicians and asymmetric information between the manager and the worker, which might all suffer from these potential biases. Thank you.